Stocks are mixed here to start today's trading session. You got the Dow still in negative territory. Treasury yields are falling. The moves coming on the heels of the producer price index that was released ahead of the bell, unexpectedly dropping in the month of May. The latest here, maybe some evidence that inflation is continuing to cool. We want to bring in Brent Schutte. He is Northwestern Mutual Wealth Management's Chief Investment Officer. Brent, let's talk about this data that we're getting out here this morning, what ultimately this means here for equities. We've seen almost this risk-on rally here over the last couple of prints as the market searches for any sort of good news within these reports. I'm curious what you think, what we heard from Powell yesterday, the likely timing here of the Fed, ultimately what that means for the equity markets here in the short term.
Yeah, well, I think investors are discounting too easy of a process. They think miraculously inflation is going to come down without causing or having the economy slow too much to cause a recession. They think the Fed is going to be able to miraculously cut rates and keep a slowing economy from moving towards a recession, which I think there was some data on the other side this morning. Jobless claims spiked to 242,000. Continuing claims are higher. And so to me, at least history would show that it's not usually an easy process. The Fed has trouble slowing inflation without causing a recession. And to me, that is still where we're looking at is right now, the good news on the inflation side, does it mean the economy is slowing or not? Which I still think it means the economy is slowing. And typically it takes a while for Fed rate cuts to actually work their way in the system, just like it does Fed rate hikes, which you're seeing right now.
Do you think then we're still heading towards a recession, Brent?
I do. I mean, I still think it's the most likely outcome. Certainly it's been stretched out, but there are parts of the economy that are wobbling already. The low-end consumer is hurting from credit card and auto loan debts. To me, the big question has always been, can rates come down quick enough to kind of pull back the impact of rate hikes, which are still working their way through the economy? If you think about the commercial real estate market, more and more that we go longer with rates higher, more and more properties are selling for large discounts from where they were. The longer rates remain higher, consumers continue to weaken under the impact of credit card and auto loan rates that are higher. And so I do still think you're likely to see a recession. It never has happened, at least in the past, without that being the case. This time could be different, but I don't think so.
So, Brent, then what are you advising investors to do right now? Is it time to stay defensive? Where are you seeing those opportunities?
Yeah, this is where I think you all say the market's moving higher, but do you all realize that over the past 3 months of this quarter, while the S&P is up, every other part of the market's down? And the S&P has been driven by the Mag 7, which are up 17%, while the rest of the S&P, 493 names, are actually down 2%. And so it's a very bifurcated economy. It's a bifurcated market. To me, parts of the market represent value. Value doesn't be a very good timing tool. It's not an instant gratification trade. But I do think fixed income provides value, even though I think you might have to have higher rates to get that recession. I think if you look at the 10-year Treasury, for example, I don't think people realize that if it rises 100 basis points in yield, you only lose 2% over the next year. If it falls 100 basis points, which I think is more likely through a recession, you get 12% total return. Small and mid-cap stocks trade at remarkable discounts to the S&P 500, which trades at 24 times historical earnings or 12 months earnings. And 22 times forward 12-month earnings, which are expensive. And so I think there's opportunities for investors. Unfortunately, they're not in places that people are looking right now.
And so as we're thinking about portfolio pivots, what is the playbook that investors should be enacting, if they haven't already, in line with what you were just mentioning, in some of the opportunities that are out there and perhaps the areas that they should be rotating out of that have already seen the run-up or the gains?
This is the hardest thing to do because it can last for some time, where you have a certain part of the market that's really narrow, driving the gains forward, and people want to pile into that. And if you look historically, every economic cycle has had different leadership. And so an economic cycle from recession start, the start of the next recession, at least going back to the 1980s, every economic cycle's had different leaders. And the leaders of the past economic cycle typically become the laggards. Think about Japan in the 80s. It took 34 years to make new highs. Think about tech back in 2000. It took 17 years to make new highs. Think about China in 07. It's still half of what it was. And so to me, the biggest risk that I think is that investors get attempted to concentrate in a particular part of the market. I think valuation matters, not necessarily in the near term, but in the intermediate term. And I think diversification still works, despite the narrative that I keep seeing more and more to the contrary from news outlets and articles that are out there.
Brent Schutte, who is the Northwestern Mutual Wealth Management Chief Investment Officer. Brent, great to see you. Thanks so much for taking the time here today just after the opening bell.
Thanks.